Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, and here's what we're watching today. First up, we'll have full coverage on the AI trade as Alphabet puts pressure on Nvidia. Plus, we'll hone in on retailers as Best Buy, Dick's, Abercrombie, and more report their numbers. And we'll speak with the CEO of Stu Leonard's about the cost of a Thanksgiving dinner this year. Let's take a look at the major averages and the action that we are seeing today. It's a mixed picture. The Dow right now is up about 140 points or so. The S&P 500, very little change to the downside. The Nasdaq down about 0.4%. It is, of course, Thanksgiving week, a holiday-shortened trading week. That means that trading volumes are likely down this week. By the way, we just did get U.S. November consumer confidence from the Conference Board coming in lower than estimated at 88.7. The estimate was for 93.3. So put that in the mix of all of the things that we are weighing in today's session. Speaking of things we're weighing in today's session, Alphabet's market cap is getting a little bit larger. There was a report in the information that Meta is buying TPUs, tensor processing units, not to be confused with GPUs, graphics processing units, and it's buying them from Google, aka Alphabet, instead of Nvidia, although undoubtedly it's buying chips from everyone, but it is making a buy according to the information from Alphabet. Those shares are up by 2% today. Of course, we've seen a big move upwards in Alphabet year to date. And let's switch it on over to the market cap because we are on 4 trillion watch for Alphabet. Not quite there, 3.394 call it at the moment, but we'll be watching to see if it gets that $4 trillion level. Meanwhile, Nvidia's market cap is getting smaller. Its shares are falling today on the back of that report, now down by 6%. They've been accelerating to the downside. By the way, it's not just Nvidia that is feeling that pain. If we look at the semiconductors today, you've got Nvidia here. ARM is down by nearly 5% here today. We've been watching AMD that's been falling as well. It's down by 8%. So definitely it's not just Nvidia that seems to be falling as we are seeing those Alphabet shares rise. One of the other themes that we are watching, of course, in today's session is what's going on with retailers as we continue to get retail earnings as well as the retail sales numbers, although they're lagging for September. Here are going to equal weight the retailers as well to see how they are stacking up. Kohl's standing out today. Those shares are up about 34%. Now here's the year to date. They've been recovering as of late. They just announced a permanent CEO and then this morning came out with earnings. That's fueling the shares higher. Abercrombie shares are up by 22%. So, year to date, not so good, but up today by 22%. I guess that puts it in perspective. But we talked to Jerry Storch, who is a retail veteran, yesterday, and he talked about really it is a retailer by retailer situation here. And I guess this map shows that as well. You got Dick's Sporting Goods all the way down here. It's down 13% year to date, down another 4% today, being weighed down by Foot Locker. And then we also had Best Buy reporting today. Those shares are up by 5%, but it's also had a rough year. A lot of these retailers have had a rough year. Let's dig into the retailers more now. I mentioned Dick's Sporting Goods. Dick's is raising its full year outlook after reporting strong same-store sales, but the stock is under pressure due to concerns about charges from that Foot Locker acquisition. Joining me now, Michael Baker, D.A. Davidson, Managing Director and Senior Research Analyst. We'll get to some of the others in a moment, Michael. But I do want to start on Dick's because it's an interesting situation here where its comparable sales at the Dick's stores themselves were up, 5.7%. So how much of a problem is Foot Locker now in this acquisition for the company?
Well, the Dick's business, you're right, is doing really, really well. I think in terms of the Foot Locker turnaround, you just got to give it some time. The deal closed September 8th. Dick's management is being very aggressive in clearing inventory and potentially closing stores. We think they will close stores. They haven't told us how many yet, but they are aggressively clearing inventory and setting Foot Locker up for a better 2026. So that's going to cause some pain in the third quarter as well as the fourth quarter. That's why the stock's down. We don't see that as particularly bad news. We like the fact that they're being aggressive. We're willing to give them a pass on that for a quarter or two, with the idea being that throw in the kitchen sink now and set up Foot Locker to perform better in 2026 throughout the year.
And what about Dick's itself, and the gains that it saw? What do you see as sort of fueling that?
Market share gains. They're just doing a really good job in terms of merchandising. It really starts there. So comping at 5.7% has now been 6 or 7 quarters above 4%, way above the industry. I think a lot of those gains are coming as Dick's gets bigger and bigger, and the Foot Locker deal, certainly contributes to that. They're getting better product from all the key vendors. This is the big brands as well as emerging brands, and it's just setting their store apart from every other sporting goods retailer out there and driving market share. So it's really a merchandise-driven story at this point.
And so when it comes to Foot Locker and sort of integrating, I mean, where do you see as those points of synergy or points of coordination between the two separate brands? And are you concerned at all that Dick's hasn't let us know yet how many Foot Locker stores it's closing?
Well, there's certainly risks to the deal. I'm not concerned that they haven't given us those numbers yet. This deal closed on September 8th. That's
Fair.
2 months ago or so. We'll give them 1 quarter. They promised us those numbers at the end of the fourth quarter. I think that's appropriate. Really, two big areas of synergies. One is going to be in buying synergies. Just as a data point, Dick's is now 38% of Nike's North American wholesale business with the combined Foot Locker business. So they push a big pencil. They're going to buy better. They're going to get better product. They're going to pay less for that product from the big vendors, and that's going to help the margins. But we think the bigger opportunity is really improving the merchandise at the Foot Locker store. So clear out all this old garbage, really, as Ed Stack called it, Dick's chairman today, and start to put in better product, including, of course, footwear, but also starting to put in some apparel and other things that are sold at the Dick's stores that Foot Locker has never had access to. We think that could be a huge opportunity for the Foot Locker chain.
Let's turn to Best Buy now, because this company, too, came out with better same-store sales, up by 2.7%. That's the best number they've had in a while here. What does that tell us? Do you think that then this turnaround is sustainable sort of through and beyond the holiday season?
Yeah, it's product cycles, and we're seeing a lot of the product cycles start to work for Best Buy. Computing has been strong now for about a year and a half, and it's actually accelerating. Basically, everyone bought laptops when COVID started 4 or 5 years ago, and now people are needing to go back and refresh that. So it's very much what we expected in terms of product cycles for the PC business, and you're starting to see it kick in a little bit for gaming. Phones have been strong. We still have some weakness in areas like TVs and appliances, but actually TV units were as good as they've been for a long time. Best Buy is having to get a little bit more price competitive there, but you're starting to see these product cycles really work, and that's what's driving the better comps.
And also, speaking of product cycles, I'm curious what you think about the gaming product cycle, because I think that's something that worked for them as well in the quarter, like handheld stuff, like the Switch 2, for example. Where are we on that cycle, and how much is that going to potentially benefit them?
Yeah, it's a good category for them. It really helped in the second quarter with the Nintendo Switch 2. That did slow a little bit in this quarter, but was still a positive. But again, as you said, you're seeing strength in handheld games. We think that'll continue throughout the holiday season. The wearables, the headsets, that's working. So we think gaming is a nice little sort of category enhancer for them. Not nearly as big or as important as laptops or desktops or tablets, those types of things, but gaming starting to work is certainly a positive in terms of product cycles.
Michael, I want to take a step back, because as I was mentioning before, it's fascinating this year how much of a divergence there is in some of these retail stocks, right? I mean, just pretty dramatic, and you always get some divergence, but how unusual is it this year? And then how much opportunity does that potentially create, especially for some of the beaten up names?
Yeah, it has been a strange year. There's really, in my space, only been 3 or 4 names that have outperformed the S&P 500. Now, it's very hard for a retailer to outperform the S&P 500 because you're not a Mag 7 name, but it's been basically the auto parts retailers, Ulta Beauty of all names, and Walmart have outperformed the market. Everyone else is sort of lagging. Even today, or this week, I should say, you see a huge divergence. As I look at my list here, Walmart, Dick's, Best Buy, Kohl's, Gap, they all beat same-store sales earnings going back to last week. But then we had Target, Home Depot, Lowe's, BJ's, Abercrombie & Fitch, and Burlington miss. So it's very divided. Half the company's beating, half the company's missing. Very, very, I think, company specific. But in general, that's related to the same-store sales. as it relates to the stocks, it's very hard for retailers to outperform tech companies right now. But there have been some bright spots. Again, we'll point to the auto parts retailers as favorite names in particular. Walmart has been a good one. In terms of discretionary names, again, of all things, Ulta has been a really strong stock year to date.
And what do you think then happens next year? I mean, because the ones that have underperformed, at least in some cases, it's an execution problem, not necessarily a sort of general macro problem. But what do you think how do you think that starts to play out in 2026?
If I were to have a macro call for 2026 right now, rates are going to come down. We're starting to see that already, and we're going to get a new head of the Fed as soon as May, and we think we'll be much more aggressive in cutting rates. And so we think we'll see mortgage rates start with a 5 handle. That's going to drive housing, and housing drives a lot of purchases. So we're fairly upbeat in terms of retail sales next year, but needing the Fed to help. If we didn't think the Fed would cut, I think it would be a pretty slow environment. But I think there will be some stimulus next year in the form of lower rates.
All right, Mike, good to see you. Thanks so much for joining us.
Sure, happy to be here.
Thanks. Coming up, what the latest data from MasterCard tells us about consumer spending this Black Friday and beyond. Americans are expected to spend 3.6% more on their holiday shopping in 2025 compared to a year ago. That's according to MasterCard's Spending Pulse report. But while they will be spending, deals and value are expected to be very important to stretch consumers this holiday season. Michelle Meyer, MasterCard Economics Institute chief economist, is joining me now. Michelle, it's great to see you.
Good to see you, Julie.
So everywhere we turn, we see the phrase affordability crisis, right? You've seen it. It's why Zoran Mamdani probably won the mayoral race for New York City. And so in your research, how do you kind of square that and those concerns with the fact that people are still spending?
Yeah, so I think, look, I mean, prices have increased a lot over the last several years. It's been this reset of price levels, whether you're talking about the price of goods, the price of services, or even wages, asset prices, everything just kind of level set up from the pandemic. But for the average person, as they're walking into a store or they're thinking about paying their rent or their payment for their car or their insurance, they're thinking about relative to what it was a few years back, and it does feel a lot more expensive. It feels like they have to work harder in order to get some of those items. But it doesn't mean that they can't afford it entirely, or at least not an aggregate, because you're still very much seeing that spending, right? So the fact that wage growth is still running above underlying price inflation, the fact that asset prices have appreciated as much as they have, leads to an environment where we're still seeing that growth, even though it feels like things are so much less affordable.
So of that 3.6% increase that you guys are expecting, is there a way of teasing out how much of it is inflation versus how much of it is people buying more stuff?
Yep. So we have a basket of holiday goods that we track to understand the rate of inflation and get a sense of how much real spending there is or goods. And obviously the inflation reports are a bit delayed at the moment, so we don't have updated data, but we're running at just above 2% or so for year-over-year inflation for this broader holiday basket. So there's still very much real spending and transaction expansion that's happening, which is encouraging. But we'll see as we get into the heart of the holiday season. It will really depend on how deep the promotions are this year relative to last year, and that will influence pricing. And when you think about the holiday season last year, it was a really heavy promotional season. We had deflation in a lot of these goods categories heading into this season, and consumers knew that. So they waited to purchase. They waited for these big promotional periods. They waited till the very end of this season because they knew they had that upper hand in terms of pricing. And this season is a bit different. We're heading in with accelerating inflation. It's not outrageous, but prices are now heading higher in part because of tariffs and supply chain issues. And consumers are also much, much more conscious of making sure they get the product they need at the price they want. And I think that is encouraging a little bit of an earlier jump into this holiday season on the first look at promotions.
And I guess also retailers are pretty cognizant of that. And if they can offer a deal on something, they are offering a deal on something.
Well, yeah, I mean, there's always the question of market share. So they're all competing in terms of making sure they secure that consumer and that consumer remains loyal to them. So pricing is a big part of it, but it's not the only part. And we see that very clearly in our data as well, that consumers are also prioritizing what matters to them. One trend that we've seen very clearly is influencer driven spending on apparel. So when there's, a vibe in the market and people really want that product, they become a lot less price sensitive. We are seeing in terms of spending on wellness activities as well, particularly a lot of the gadgets that people are purchasing to support their health and invest in their health. So yes, pricing matters, the search for value matters, but there's more than that that's driving consumers at the moment.
Interesting. And we also have to talk about the different income cohorts, right? Because that's gotten so much attention. So in your data, what are you seeing in terms of spending trends and how they might differ or not differ between the different cohorts?
Well, I think that goes to the macro drivers that are driving that. So when you consider the upper income household, labor income matters a lot, the state of the labor market, but also what matters is the health of the financial markets, what they're seeing in terms of their balance sheet. And if you look at the Federal Reserve flow of funds data, it is extremely clear that there's been a very positive wealth effect over the last few years with this pretty impressive appreciation in asset prices. So that provides a really nice buffer and support for the upper income cohort that is not felt the same way for the lower income cohort, which is much more sensitive to the state of the labor market. And while labor market conditions are still supportive on balance, we certainly have settled into a labor market where there's a lower churn, right? We're in a low hiring labor market, also a low firing one, which is good. But there's just not as much turnover in the workforce, which could be a factor influencing how consumers are intending to spend going forward.
Michelle, I'm also curious about this sort of experiences versus stuff thing, that theme that we've been talking about for a few years now, and how that's playing out this year. Will people still sort of balance that out or even prioritize experiences, spending on future trips, for example, to give as a gift over the holidays and what have you?
Yeah, so it's been fascinating to watch this balance between goods and experiences, as you mentioned. I mean, when you think about coming out of the pandemic, it was all about goods initially when the pandemic was still in play and you couldn't travel. And then as soon as the economy was reopening, it was this incredible rush to get back out there and to travel. And then last year, things kind of settled a little bit and we reached what felt like more of an equilibrium. And now we're getting impacted by relative price differentials. For some of these larger durable goods, they're more sensitive to trade. They're more sensitive to imports and therefore to tariffs. So the extent to which there's more value being felt again now in experiences that don't have that tariff impact, I think it could encourage consumers to lean more into that purchase, especially if that's something that they value. When we look at our own spending pulse data, we saw a really impressive acceleration in spending on airlines and on lodging and on restaurants throughout the summer into early fall after a little bit of a more rocky start to the year.
This is getting my gears turning about what I need to start. I'm very behind. So what I need to start jumping on, Michelle. It's great to see you. Thanks so much for joining us.
Great to see you, Julie. Thank you. Good luck with the shopping.
Thank you. Coming up next, we're going to be talking much more about consumer confidence. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching Symbotic, SanDisk, and Zoom. First up, Symbotic, the automation technology company, out with a strong forecast for first quarter revenue. The outlook beating the average analyst estimate on Wall Street. And the company also announced Medline as a new customer and the company's first customer within the healthcare vertical. Those shares surging by 40%. Next is SanDisk. The flash storage vendor was added to the S&P 500. SanDisk's addition to the benchmark comes 9 months after the company was spun out of Western Digital. Western Digital originally bought SanDisk in 2016 and then spun it out in February. It's the latest tech company to join the S&P 500. Stocks do tend to rally when they're added to the benchmark index, as fund managers who track the S&P need to buy shares to reflect the changes, but the shares are a bit down today. Maybe the buying happened in advance of the entrance. And finally, Zoom, the video communications company, reporting quarterly revenue that topped analyst estimates. Zoom pushing a broader range of products, including corporate phone systems and contact center software. The results indicating its expanded suite of business tools paying off. The company is looking to regain momentum after becoming a staple of the stay-at-home trade during the pandemic. The shares right now up almost 11%. Well, Conference Board consumer confidence data this morning coming in well below Wall Street's estimates. Consumer confidence slid in November by the most since April amid anxiety over the labor market and economy. Joining us for more is Yelena Shulyetyeva, the Conference Board senior U.S. economist. Yelena, what's going on here? What are sort of the inputs and how striking was this data to you?
Yeah, I think I have a little bit of a less optimistic view of the consumer than Michelle was talking about earlier. So yeah, broad-based decline in consumer confidence in November across jobs, incomes, and financial situation expectations. And that is probably due to a government shutdown. Remember, we were still, in a shutdown kind of mode during most of November. And I think we will see next month. But a couple of things that worry me about this data is that financial situations, families' financial situations assessment actually faltered quite significantly in November. And this, how much does it have to do with the shutdown itself? So families know about what their finances are, right? So they're talking about their own assessment of their own finances, and that was not pretty. So consumers actually cut on spending plans for services, amusement parks, things like that. So that is also telling me that discretionary spending plans at least are declining.
And of course, the labor market differential always gets a lot of attention too. The share of consumers who say jobs are plentiful, minus the share saying hard to get, it was down again in November. We had been up a little bit in October. And Yelena, you know very well that we haven't been getting jobs data. We're not going to get the report for October, for example. So what does this maybe indicate about that?
Continued lack of churn in the labor market. It's kind of like frozen. I think we're not laying off a lot of people. We're not hiring a lot of people. But the unemployment rate continues to creep higher. And the labor differential from the Conference Board survey actually has quite a lot of correlation with the unemployment rate itself. So the labor differential index has been on a consistent downward trend this year, despite that 1 month of a pickup in October. And that seems to be more or less in line with what we see in the overall unemployment data, right? So it's not a significant increase, but it's a persistent increase in the unemployment rate driven by consumers' inability to find jobs.
I was also struck by the demographic differences, right? Because on the one hand, we keep hearing that young people are having more of a tough time getting jobs, but confidence is improving for people under 35. Confidence not great for people over 55, even though you would think those folks would be watching the market go up and maybe be happier. I don't know. Yelena, what do you think of those various breakdowns?
I think it's misleading to look at month-on-month fluctuations in the data. Overall trend is lower confidence across demographic groups and across income levels as well. So I think a broader picture is that at least what people are saying tells us they are entering the holiday shopping season with a little bit more caution.
Yelena, I'm going to ask you the question that I think I always ask you, which is, this is how people are feeling. This is what they say they're going to do. They don't always do what they say they're going to do they? So, how do you think about the intentions to spend versus the actual spending?
I think the truth lies somewhere in between. People are concerned. People are concerned about the labor market. There's some information in there. And look at retail sales this morning. Overall, Q3 retail sales were robust. If you look at the data for the quarter overall, it's still tracking very well and suggesting consumer spending in real terms will be pretty robust in the third quarter whenever we get the results. But towards the end of the quarter, there's a little bit of a caution on the part of the consumer. They're telling us by their action that they're stepping back from some discretionary purchases. And that is a little bit of a concern to me as a signal going into the holiday shopping season.
Maybe we need to get you and Michelle on at the same time next time.
That would be awesome.
Get a little debate going. Elena, great to see you. Thank you.
Happy Thanksgiving.
You too. Coming up, we got a check on the health of the travel industry. Our conversation with Delta Airlines CEO Ed Bastian from Yahoo Finance Invest. That's next on Market Catalysts. The holiday travel season officially kicking off this week, with the TSA expecting to screen nearly 18 million people between today and next Tuesday. Executive editor Brian Sozzi spoke to Delta Airlines CEO Ed Bastian about the state of the travel industry as part of Yahoo Finance Invest.
Delta celebrating 100 years in business, and suffice to say, a lot has gone on in the 100 years within the aviation industry, within the consumer, within the world. I'm really excited to bring in our next guest here at Yahoo Finance Invest, Delta's longtime CEO, Ed Bastian. Ed, good to see you here. 100 years, mind-blowing thing in corporate America, mind-blowing milestone. What does that mean to you?
A lot of pride in our people for getting there. First U.S. airline to reach 100. It's quite a statement when you think about all the challenges our industry faces, the hundreds of airlines that have come and gone. To have Delta reach not just the mark first, but the first to the second century of flight, and the head start that gives us on our future. But it's about people. It's about service. There's something about Delta that's in our heart. It's in our DNA. It's the consistency of excellence that we look to provide. We have great planes. We have great technologies. We have great lounges. We have great places we go. But it's the people that really make it special. I
want to dive into all that in large part because I am a loyal Delta flyer. I am, and I'm just fascinated by the travel experience. But you mentioned challenges, and the aviation industry has been undergoing some challenges with the government shutdown. At a high level, what disruption has this caused for a business like yours?
It's been very disruptive. For the last week, when you go in with no notice and you just arbitrarily reduce the amount of flying in the system for all of us, incredibly disruptive for our customers. We had no advance warning to be able to get people to different places, so there were delays. When you couple that with the amount of the accelerated pace of staffing shortages in the towers, which I think was somewhat tied to what we were seeing with the forced reductions. Controllers are, and by the way, hats off to them, particularly those that have been working without pay for almost a month and a half. Really, really big thanks, and security agents that are doing that. But the reality is that there was stress, there was strain. It was completely unnecessary into the system. It's our industry that forces, I guess, even government to get back together and to open up. So be it. But it's causing a pretty significant disruptive end. The good news is that I anticipate we'll be fully up flying very, very soon, in the next day or so, and hopefully when the next time comes, we'll find a better solution.
Hopefully there is no next time with this.
But there always is.
Yeah.
But hopefully it's not our industry and our people and our customers that have to bear the brunt of the dysfunction, because the people that we put in power to run the country can't agree.
What this has exposed, this record-setting shutdown, Ed, is, like you mentioned, the shortage of critical people that allow planes to safely go in the air, the aging infrastructure. From your vantage point, how severe are these issues?
We're safe. We're absolutely safe. The safest form of transportation, period. And that's what we do all day long. We talk a lot about our brand, as I said, the airports and the fancy places we go. Internally, we talk safety all the time. And if you're not seen as safe, if you don't have that core trust element with your consumer, you can't do the things that we do. So incredibly safe. We've been accelerating over the last decade the retirement and the replacement of our fleet. Our fleet actually has gotten younger in the last 10 years. COVID partly helped, but we retired a lot of old planes during COVID, the 777s, the MD-80s, excuse me, the MD-90s, and several other older models. And we haven't had an issue, because we've been with Airbus for the last 5-7 years, getting all the deliveries that we expected. They've been operating right through this period.
What has to happen to get more air traffic controllers into these spots to backfill positions that maybe aren't being backfilled?
Well, one of the most important things is to modernize the skies. The air traffic control systems were developed decades ago, 50, 60, 70 years ago, still using some of the same technologies, the same infrastructure, very manual. And when you have an environment that's as stressful, that operates with such manual intensity, it's safe. But it's safe because things get slowed and they maintain a big margin for error to keep us all safe, which we appreciate. But the reality on that is today it takes longer to fly from Atlanta to New York than it did in the 1950s when we launched that route.
It's hard to even grasp.
It's hard to grasp, but that's because the system is so taxed and so it's so slow. So you do circles, you wait in lines, and you don't have the modern technologies that we use in many other transportation industries. By the way, many other air traffic systems around the world have much better technology than we do in our states. Kudos to the administration. They got $12 billion investment to get started this year. Again, it was another thing that probably was delayed during this shutdown period, and we got to get it going again. But we all need to make that investment, and that's just a down payment. I think the real cost is going to be significantly better. I don't know of a better return that you can have, because just think about how much time it's going to save being able to use the technology, how much safer it'll be. You know, the elapsed savings that you're going to see in terms of sustainability and fuel and giving people their time back, and then allowing us to grow at a much higher pace than we've been able to grow.
You know, from the outside looking in, people might think after a shutdown, everything gets back to normal. We're all good, dude. We're going to travel and get to where we get to. Is that the case? I mean, can you just literally flip the switch and things go back to normal?
There's no flipping the switch. You know, we got crews that we got to get back ready for, because we've been taking flights out for a couple of days, in advance in time, and now we got to see if we can get those crews back on schedule. It'll take several days, but I'm hopeful that by the weekend things will be running very well. The last couple of days have been running pretty good in anticipation of an agreement, and I hope that's a good baseline to look at.
Ed, you're seen as one of the best CEOs in the game for a long time. How have your past few weeks looked different? When you see a government shutdown, how do you manage your teams differently? How do you manage your people differently?
It's frustrating. It really is. We've had, our business has been doing great. We had earlier issues.
You just had record revenues.
Record revenues this year, but we had earlier issues at the start of the year with all the geopolitical announcements, the tariff debates, the announcements, the uncertainty that existed in the economy really froze the economy. And our business runs on economic growth. And when you have the economy basically stall, which we saw happen in the February, March, April timeframe, brought our bookings down pretty considerably. We got it back up June, July. Things started to take off again. We're looking for, and we will have a great holiday season. Things were looking great. Then all of a sudden you have a shutdown that occurs, something that comes completely out of your control, but out of nowhere. We can't do business like that. We need more, from our government leaders. So we have made our points known with all our people, our elected officials. Do your job. Do your job. And I understand there's disagreements, but it should not come at the cost of asking people to work particularly in high stress, incredibly sensitive areas without pay for weeks on end. That's inexcusable.
Is the consumer okay?
Consumer is strong, but again, it depends what consumer you're talking about. Our consumer in the experience economy, the higher end experience economy, is doing incredibly well. And we've seen this for the last several years. The higher the experience set goes, the more premium it is. The demand, it seems to be insatiable. It just continues to grow. Whether that's international experiences, whether that's a hot concert tour, or last night I was at a great restaurant in the city. It was packed, hard to get a table. That's where people continue to want to invest because they see great value. They see great opportunity. If you're providing a commodity, if you can I can do this, I can do that. If price is your determinant, that consumer isn't doing too well.
Coming up after Alibaba reported revenue that beat estimates, we'll discuss what that means for China's broader e-commerce sector. And by the way, those BABA shares are lower. We'll talk about that too. We'll be right back. Shares of Alibaba slipping this morning, that despite the Chinese e-commerce giant reporting a 34% boost in its AI division, part of an overall 5% quarterly revenue gain. Let's bring in Brian McCarthy, Macro Lens Managing Principal and Chief Strategist, for a look at what this means for the company and for Chinese e-commerce sector more broadly. So Brian, let's talk about Alibaba first of all, because the numbers initially looked pretty good. I don't know if there's some concerns about costs. How are you reading those numbers?
Yeah, well, to be fair, the stock popped 5% yesterday on their announcement that their Qwen AI model has been downloaded 10 times in the week since release. So that sort of set a high bar for today's earnings release. Although it is somewhat concerning that the stock was up pre-market 5% this morning and is now down about 2. That could be also in sympathy with Nvidia coming off and some heaviness in the U.S. tech sector. But I think the big picture question for Alibaba is one of scale versus profitability. So you mentioned the 5% revenue gain. That market was looking for 2 or 3. That was good. On a like-for-like basis, if you remove units they've disposed of, revenues were up 15%, 34% in their cloud computing business, and up 60% in the quick commerce, dominated by the food delivery sector. So very strong revenue growth, but earnings down 72% because they are investing very, very heavily in both AI and in this quick commerce segment. And both of those segments come with great questions as to whether the heavy upfront investments will at some point pay off in terms of high profitability in the end.
Well, obviously, that's a familiar narrative because it's one that we've been debating for the U.S. tech giants as well. So what's your assessment then as an investor? Do you think that it's going to pay off? And do you think that, that it's a good bet?
Yeah, it was an easier bet to make a year ago. Alibaba's doubled since then. So, the valuation is not the strong driver of an investment thesis for the stock as it might have been a year ago. And at this point, I'm mixed at best, frankly, because, let's talk about the quick commerce business where they're investing very heavily. Sales and marketing expense above $9 billion, that doubled on last year's third quarter. So they're spending a lot of money to gain share. And the U.S. paradigm is, look at Amazon. They had this very long runway of, spending to gain share, and that ultimately, produced a dominant market position in which they could generate profitability. The track record for that kind of thing is not so great in China because you just tend not to see the same kind of market consolidation. Businesses don't tend to go bankrupt in China, particularly large sort of dominant businesses that have a provincial or central government protector. So it's not clear that the same story will hold for Alibaba. Frankly, I'm skeptical. And, I think more broadly, the Chinese markets look to me like they've topped. The economic backdrop in China is quite negative. Alibaba is still somewhat settled with a core e-commerce business that is just not doing great in an environment of deep-seated deflation and slowing growth in China. So I'm not real enthusiastic about the shares from here.
It's interesting because I've heard a lot more optimism about China, this year at least, than vis-a-vis expectations, Brian. But do you think that's kind of behind us and that it's already priced into your point about what Alibaba and many other stocks have done?
Yeah, so paradoxically, I think the trade truce with the U.S. is a bit of a negative for Chinese equities because when Chinese leadership was in this existential fight with the U.S. that's on hold for a year, supposedly, it was really in their interest to get equity markets off the floor, generate some excitement in Chinese assets. It helps shore up their currency, and that so that was a strong policy push from the central government starting about a year ago that I think was really a great tailwind for Chinese equities over the last year. Now that we're in this détente, it doesn't make sense for policymakers to push these stocks into an area where they might be, vulnerable to a sell-off. It just creates a negotiating vulnerability for the Chinese government should tensions with the U.S. reemerge. So I think that tailwind, the policy tailwind, is lessened, and that goes for stimulus. I don't think they're going to do a big economic stimulus, despite some very, very weak data, particularly in the fixed asset investment category. Double-digit declines year on year the last few months. We've never seen this before, really, in China. So I think they're going to be reluctant to stimulate. They're not going to want to cheerlead the equity market the same. And again, with valuations having doubled, it's just not as exciting a proposition as it might have been a year ago.
I mean, we know that Trump and Xi spoke yesterday, although that seemed to have been more about what was going on with Ukraine and Russia, but they touched on some trade issues as well, I believe. Do you think that there might be the potential for any kind of short-term catalyst when the two meet, if there's some more announcements?
Well, potentially, if China were to accept an offer for the U.S. to sell Nvidia chips, because one thing that came up on the Alibaba conference call was that despite the 34% increase in cloud revenue, they're capacity constrained. They have more demand than they can offer clients. So there is a question there, given the very strong policy push for domestic chip usage, whether they can continue to grow that business or whether there's going to be a constraint created. And I think in a way, if they were to open up the door to some Nvidia chips, it's not clear Chinese policymakers want that. I think Trump would offer it. I think that actually could be a tailwind to Alibaba's cloud business in terms of it being able to sustain continued high rates of growth, which again are in question because Chinese policymakers really don't seem to want these Nvidia chips, and they do want to force domestic compute to be run on homegrown chips, which is easier said than done.
Yeah, that's definitely a point of suspense in the whole story, and we'll be watching it closely. Brian, thank you so much for your perspective. Appreciate it.
Thanks, Julie.
Coming up, we'll have full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. As we take a look at the major averages, we continue to see a mixed picture on this holiday shortened trading week. The Dow is higher by 315 points or so, but the S&P 500, very little change, slightly to the upside. The NASDAQ is down about 0.4%. I'm just looking at the groups in the S&P and what's on the move here. Healthcare and consumer staples are performing the best in today's session. Tech and energy are a drag, so that's the sort of balancing act that equals a 0.1% gain in the S&P today. Consumers are cutting back on their holiday toy budgets this holiday season, with 14.3% of people expecting to spend much less. More than 26% expect to spend somewhat less. Joining me now is Jay Foreman, Basic Fund CEO. Jay, it's good to see you again. Obviously, people are trying to kind of make choices, balance their budgets this holiday season. How are you guys seeing all of this play out for your business?
Well, right now, I would say Santa's sled is revved up in third gear. We don't see the most robust holiday season, but we're in the toy industry, and generally people don't skimp on toys for their kids. There's other products they might not buy over the holiday season, but they're kind of going to buy toys. But our season has really been impacted this year by tariffs. There's no doubt about it. Between the closure or the sort of de facto embargo with Liberation Day in April at 145% tariff, it's really stunted the opportunity for growth in our industry this year. But we think the consumer's going to show up, but it's not going to be the most sunny Christmas that we've seen in a long time.
Well, Jay, let's talk about that. Let's sort of break that down, right? Because the tariffs, obviously, we're not at the worst case scenario where we were in April. But we're not in the best case scenario where we were January 1st either, or the better case scenario, right, in terms of tariffs having been imposed. So I guess let's take sort of it in two buckets. One is supply chain and inventory, and the other is price. So price-wise, how much have you all had to raise prices in order to account for the tariffs?
So the first part of the season, when tariffs first hit, pretty much our costs were already baked in with the retailer. We had already quoted those prices last year. A lot of the goods were already shipping and on the water. So for the first, let's say, 9 months of the year, very difficult for us to push too much of that cost across to our retailers or the consumers because it was in. But for the last quarter of the year, for the fourth quarter, consumers are going to start to see the tariff pass through a lot. I'll give you a perfect example if you'll allow me. This Tonka Mighty Dump Truck, which is a great item, steel dump truck, was $25 pre-COVID. Post-COVID, the price went up to $30 through the supply chain crisis, 23, 2022. It's now $35 to $40 online because of tariffs. So, you're seeing the price go up. Now, this is a great value item. So even for $35 or $40, it's a nice value for the consumer, but it's still 15 $10 or $15 more than it was, previously. So the consumer's going to feel that, and they're going to have to decide how many toys they're going to be able to buy, as well as all the other Christmas gifts this year. So prices are definitely going up.
I know it's not what it's meant for and it's too small, but I definitely remember my kids trying to ride themselves around in some of those trucks when they were much smaller, Jay. Okay, so that's the price part of the equation. What about the availability part of the equation? Because of these increases and the sort of stop and start and not inconsistency of how the tariffs have been applied, is there some stuff that there's not going to be enough supply of?
Sure. When Liberation Day hit, especially for China and a lot of other countries in the supply chain for toys, there was really a de facto embargo. Everybody pretty much stopped shipping for 6 to 8 weeks. So that stunted the supply of goods on its way. And then the knock-along effects of whether tariffs would go up or go down over that period of time, and the uncertainty with the consumer really has gotten the retailer skittish. So from what we can see, the retailers have purchased less toy product this year than they did last year. There'll always be products to buy in the stores. There'll always be things you can find. It's always a question of, will the things you really want get sold out quickly? So consumers will be able to find toys. It's what kind of toys will they find, and is it the right thing that your child really wants? And is the price going to be a little bit more expensive? And the answer for the first is you won't see as many of the toys your child wants as the season goes on. And yes, the prices will become more expensive for toys.
And Jay, we're showing some of your brands there. Of course, you showed the Tonka truck. We see the Care Bears behind you there where you're sitting. Can you tell us trend-wise sort of what are some of the most popular items that you're seeing this year? And is there going to be enough of them for people to buy?
Right. The biggest trend we see this year, interestingly enough, is not really traditional toys. It's trading cards.
Right.
So Pokemon, Major League Baseball, Magic the Gathering, NBA, those are super, super hot. And you're going to find those really hard to find. Of course, you may be familiar, if your kids are getting a little bit older, with the Labubu craze. So what we call blind box toys, surprise open toys, are in demand, lower price, somewhere between $5 and $15 or $20 a piece. Those toys are selling out and they're going to be in demand. So those are the biggest trends we see. Lego obviously continues to do an amazing job with the products they create. And that's kind of what's happening. But I was doing store checks over the weekend, and I can tell you that very hard to find a lot of the trading cards that kids want to buy. And there are a lot of holes in the shelf because things are selling out that are most desirable. And it just seems there's less of a product flow coming in from Asia for toys this year.
Thank goodness my kids are not into Labubus, Jay. But are you guys in the collectibles business at all? Do you have anything in those lines?
Yeah, we're definitely in the collectibles business. We make a line of toys called Littlest Pet Shop. So
yes, I'm familiar.
Little, really cute figures, the Littlest Pet Shop figures. We make little squishies like Mash'ems. So we're definitely in the collectibles business. And it's been really thriving because these are, what the English would call pocket money toys. So these are toys that might be $3, $5, $10, for young adults, even $15 or $20. And they bring a lot of joys. You can buy them in little bits and then end up with a big collection of them. So collectibles is super hot right now. Things like Littlest Pet Shop, things like Five Surprise are really in demand at this point for consumers.
Jay, finally, getting back to tariffs for a moment, I think the last time we talked to you here at Yahoo Finance, you talked about the exposure to China for your manufacturing. Have you guys diversified at all? What kind of flexibility have you had to try to just diversify your supply chain in response to all this?
Well, we had some big decisions to make, whether we moved out of China to places like Vietnam or Indonesia, India, Cambodia. We made a decision to stay in China. It's the most reliable supply chain manufacturing hub for toys that there is. And I really felt that a deal was going to be made between the US and China. And that's proven out because the tariffs now at 20% are pretty much equal to those in Vietnam, Cambodia, Indonesia. It's much less now than India. India is 50%. So we've kept the supply chain pretty much intact in China. It's not that easy to move these products around. And of course, while we'd love to bring the production back to the US, there's really not a ready labor force here, nor the capital to set up factories. So what we're really hoping more than anything, in the coming weeks is as the story moves from how affordable it is to buy a Thanksgiving dinner to how affordable it is to buy Christmas presents, that we hope the war on Christmas presents ends and tariffs come off toys. I certainly would vote for a Nobel Prize for the president if you took tariffs off on toys and stopped the war on toys. But that's one way to get prices down. But from a supply chain standpoint, China's still pretty much the hub. We're always looking for places to diversify, but we're really hoping for our Christmas wish is that tariffs go down to zero on this toy industry, which is a non-strategic industry that doesn't have a manufacturing base here.
Right. Jay, thanks so much for your time. Appreciate it. And happy Thanksgiving.
Thank you. You too. Happy holidays to everyone. Bye-bye.
Coming up, we're going to head to the grocery store and check in with Stu Leonard Jr. about how to keep your holiday meals within your budget. Speaking of which, stay tuned. You're watching Market Catalyst. Thanksgiving is here, and for a lot of people, shopping for turkey and all the trimmings is a lot more expensive than a year ago. But smart shopping can perhaps help keep your holiday season food bill under control. Let's check in with Stu Leonard Jr., CEO and president of Stu Leonard's, the grocery store, and on the front lines as shoppers stock up on food items for the holidays. So good to see you, Stu, as always, in the store. Happy Thanksgiving to you. You know, we've been talking to a lot of folks about these rising costs, right? But we've also been talking about the turkey itself, and that a lot of retailers like you guys are offering some deals to get people in the store. So how do you think about pricing the turkey versus all the other stuff?
Well, first of all, today's the busiest day before Thanksgiving. So this is when everybody comes and shops, and then tomorrow they'll chop and prep and then have Thanksgiving Thursday. Right now, what you're seeing is basically prices stable compared to last year. There's a couple little ups and downs here, but overall, this is your big guy right here, which is your turkey. Okay, everybody's looking at that. It's the same price as last year. So you're seeing some things that are the same. There's a couple things that have gone up. I'll go right at it. Look at it, sir. You got to eat one of these, Julie, for Thanksgiving. You got two boys, right?
Yes.
They'll gobble.
One of us is a vegetarian, though, so you might need to pull out a tofurkey for me, Stu. But
okay. Well, then another thing you have is lobsters right now. These are actually down in price this year.
Interesting.
Okay. Milk right here is down in price. Okay. And of course, you have the poster child of inflation and everything, which are eggs. Okay, those are down about $1 a dozen right now. So you're seeing some relief. You know, some things that went up, Julie, coffee. Right. They got a big drought in Brazil and Colombia. And you know what the good news is right now is Trump's relieving some of the tariffs on things like bananas, pineapples, mangoes are all tropical fruit we get from Costa Rica. He's relaxed the tariffs on them, and same with Brazil. So I think you're going to see prices stable right now for Thanksgiving and possibly even start to tick down a little bit as we approach the holiday.
Yeah. To go back to that turkey for a second, Stu, is the price that you're paying the same, or are you guys eating some of that cost in order to keep it consistent for your customers?
Well, you know, it's really a balance. I mean, obviously, I can't eat everything. I would say we're eating about a quarter of the tariffs that are placed on us right now. Our family business, we're eating that. Okay, we don't like it, but we're keeping volume up, which is important. The store's packed. Customers are shopping. They're buying. If you talk to them, yes, I just saw a customer, and she said, you know, the prices, she said, are ridiculous. And I said, well, what do you mean? And she said, well, look at the meat price. And I said, yeah, that's one thing that went up. She said, but, you know, overall, for Thanksgiving, she said the prices are pretty good. And she didn't feel there was any real jump, at least in her pocketbook.
So what kind of behavior are you seeing from people if they are trying to save money in the stores?
Well, one of the things we're finding, I mean, I hope none of our managers hear me say this, but, you know, we do a lot of demos like Costco and everything. So usually you'll see sales double, triple, maybe even go up 5 times sometimes when you demo and people can taste it. Don't buy it, okay? Stick your shopping list, okay? That'll save you some money as you get through the store.
Yeah, I hope your managers are listening to that if you're giving people that advice. I know you guys do a lot of private label also, and I imagine that is popular right now.
Well, that's one way to save money is check out private labels. There's a lot of great companies out there across the country. They make great private label items. Sometimes it's the same as the national brand. So our philosophy at Stu's is we want to have an item that's as good or better than the national brand and will save you money. So you can save money doing that. You can save. One way to save a lot of money is ask your guests and your family to bring an item over to your Thanksgiving meal so you don't have to put the whole cost of Thanksgiving.
Not to mention, you don't have to do all of the work. That's usually how I think about it, Stu, when it comes to getting people to bring stuff. Yes?
Julie, that's a good point. Do it yourself because, we have kitchens that we have hundreds of people right now making gravy and chopping making cranberry sauce. That's a lot of labor. It's a lot of expense. You do that at home, you'll save a lot of money.
That's true. Although, again, save yourself a little work if you get it pre-made. So I guess you got to weigh the various things. Yes.
Well, Julie, you've studied the financial markets, right? You have a whole history of doing that. Here, I have this thing called the mashed potato index.
Okay, tell me.
Which wouldn't you assume that when people feel good about purchasing and buying, what they do is tend to go over to our mashed potatoes with the cream and the butter, but they're $4.99 a pound. Now you can go over and buy a potato for $1 a pound. So you can save a lot of money by making your own mashed potatoes at home. So we follow, where's the meter on this? Are they buying more mashed potatoes or are they buying more packaged potatoes? And this holiday right now, they're buying more mashed potatoes.
Oh, that's really interesting, Stu. All right, before I let you go, there is something that I think has nothing to do with Thanksgiving, but you're very excited about, which is something that I admittedly am not excited to try. But you've been dipping soft serve ice cream in butter?
Come on. Look at this. I brought one for you.
Okay, so that is an ice cream cone dipped in melted butter?
Butter with a little salt, on top of it, okay?
Why would we do this, Stu?
You know why? Because it got how many millions on TikTok? I mean, it was trending 10, 15. We did our own little thing about how to make this butter ice cream cone. In the store, we got 15 million views on this thing. That's why we're doing it. It's like a social media craze. You got to jump on it. So here's the thing. I'm going to take a bite of this.
Yes.
It's crunchy. It's crunchy around the top, which is sort of cool. It like sticks to the roof of your mouth, the butter. And you get a little bit of salt on there. It's really good. Okay, who doesn't like butter?
I'll have to take your word for it. I used to when I was a kid, there was a place I would go to that would do the chocolate dipped cones or the caramel dipped cones. Those I liked. I don't know if I'm a buyer of this one, but that's okay. That's all right.
You got to try it. Okay, but anyway, we're selling them at the store. If anybody wants one, come on in. You can have your own butter ice cream.
All right, Stu, it's great to see you as always. Happy Thanksgiving to you.
Thank you. Happy Thanksgiving to everybody. Take care. Yep.
Coming up, we're going to pivot from Thanksgiving to one AI giant that might be gobbling up NVIDIA's GPU business. But we'll bring you the details next. Nvidia erasing more than $245 billion from its market cap today amid a new report from the Information on Google's AI chip growth. The report detailed that Meta is in talks with Google to purchase its TPUs, a challenge to the market leader Nvidia, which sells GPUs. So what exactly is the difference between the two chips? Let's bring in Yahoo Finance tech editor Dan Howley for more. So TPUs versus GPUs, Dan, what do we need to know?
Yeah, okay. So TPUs are what Google calls their chips. They're called tensor processing units. And they're a type of, get ready for something else, ASIC. An ASIC, ASIC, is an application-specific integrated circuit. Basically spells it out. It's a chip for a specific type of application. That's really what you need to know about ASICs in a nutshell. Now, what makes them different from GPUs? GPUs, they're graphics processing units, but in the NVIDIA case, they're used for AI, are general purpose. So you have a general purpose chip over here, and you have an ASIC over here. Now, Google uses their TPUs, these ASICs, to train and deploy their AI Gemini across their various platforms. They're also offering them out to Anthropic now, and apparently, according to this, the information report, going to be working with Meta, or could be working with Meta, providing them with chips as well. So what does that mean for NVIDIA? Well, it means that exactly what we've been saying for 2 years now, that their own customers have been working on their own chips and could be competitors. This isn't necessarily new. It's just that there's the report of this deal, and the Wall Street reaction, in my mind, seems to be as though these people have never heard that Google had its own chip, or that Meta is working on its own chip and has its own chip, or that Microsoft does, or that Amazon does. All of these companies have been doing this for some time now, and it allows them to diversify beyond NVIDIA. So it doesn't necessarily mean that NVIDIA is going the way of the dinosaur at all. If anything, one of the analysts that I follow said this could be a bigger problem for AMD because they were setting themselves up to be a viable alternative to NVIDIA. I don't even think that that's necessarily the case. I think that there's still room for AMD. But the real thing for people to understand is that, when an application changes, or a company wants to, take its chip and then a chip and then use it for a different application, they can do that with a GPU chip like NVIDIA's. For an ASIC, it's not really the case because they're built for specific applications. Again, application-specific integrated circuit. So that makes it a lot more difficult. The other thing is NVIDIA has its CUDA software. Developers develop on CUDA. They're going to have to do something different if they're going to develop on TPU. So it's not exactly a one-for-one. It really is, I think, for a lot of companies about diversifying and getting access to that compute that they need. A lot of these companies are saying that they're capacity constrained. They just don't have the chips necessary to build out their infrastructure. And so if they get another source, then that's great for them. And that's really where this is all coming from.
Yeah, it makes sense. So it's not necessarily of an instead of, it's maybe in addition to the chips that they had, because we know that they are thirsty for compute wherever they can get it from. That has been the theme, Dan. Thank you so much for breaking it down for us. It's very helpful. Thank you. Well, Yahoo Finance Invest highlighted some of the top leaders in AI and crypto. Here's a look at some of the biggest moments from the event.
All these things we've been saying for 20 years, and you know what? They pissed off a lot of people in the league. I run into people all over America, and quite frankly, all over the world. People who have like normal means who are now rich because of Poundry.
The math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. There's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
It shook us all to the core because fans need to trust that they are seeing real-time competition and that the outcomes are fair.
It was 9 p.m. in that AI party. It's now 10:30 p.m. But that party goes to 4 a.m.
There are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest.
The economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
Government's going to change, tariffs going to change, leaders going to come in and out, and various other things are going to happen. You can never put all your eggs in one basket. That's always been the rule.
Vaccines have saved the world and will continue doing that. In the long term, it's the most cost-effective medical healthcare intervention.
We make an investment, and the management team, the day after we make that investment, I can promise you They are getting together and they are going to do more than they would have done faster than they would have done.
Most companies, when they think about their business, dealing with retail investors is pretty secondary or ancillary. They're worried about, making sure that they're launching products. Our business is inherently different. Retail investors are at the core of not just our investor base, but also our customer base.
We're mining Bitcoin for roughly 50 cents on the dollar every single day, 24 hours a day. We're mining Bitcoin and we're adding it, and we believe this asset's going to be transformational.
Things were looking great. Then all of a sudden you have a shutdown that occurs, something that comes completely out of your control. We can't do business like that. We need more, from our government leaders.
Bitcoin is on track for its worst month since 2022. Strategy Executive Chairman Michael Saylor joined us at Yahoo Finance Invest to talk about the state of crypto, and here's part of that conversation. Obviously, you're a serious guy, right? We've talked a number of times. You think very deeply about all these issues. But then sometimes I look at your X account and I see you posting or reposting these various sort of digitally generated images, AI generated images of yourself. They're a lot of fun, right? Of you, we're showing one of you in a top hat, various Bitcoin paraphernalia, superheroes, etc. I'm just curious how you think about that. Is that, is your Bitcoin, advocacy, is there an element of shtick to it as well? Are you having a little fun with it? How do you think about all of that?
When I was growing up, there were 3 channels on television, and they turned off the television, the signal at like 11 o'clock at night or midnight, and for 8 hours there was no programming. There was no internet. We didn't have, today, we have infinite free music, infinite free television, infinite streaming video, infinite free YouTube. You can get lost, fall in a TikTok hole, an Instagram hole. You can get on Stream and Twitch. We have managed to manufacture infinite everything. It used to be you had to have money to get a newspaper or a magazine. And now, you can see we live in a world where we have, to say 1 million times more content would be probably an understatement. So the entire society is being inundated with information, and their attention span has shrunk. And so people just don't have an hour to listen to what you have to say. Sometimes they don't have a minute. Oftentimes I think, should I say it in a podcast? Well, maybe someone will listen to it. Can I say it in 5 minutes? That might be too long. Can I say it in 30 seconds? Sometimes I'll write a paragraph and you think, no, I don't have a paragraph. People will read the first sentence, and then I write the sentence and I think people aren't going to read to the end of the sentence. And so the thing you learn from social media is you need to get to the point. So how about tell me what you want to say in 1 second? And the cliche is a picture is worth 1,000 words. And so sometimes I don't give you 1,000 words because you would lose 99.9% of the audience. In fact, I would say you'd probably lose 99.99% of the audience. If it took 1,000 words, show me the picture, and that will go viral. And you're doing people a service to give them an idea that travels 1 million times faster, that is 1 million times easier to digest, because people just don't have time. They're busy. They're being inundated. And when you see those images, that is us communicating something cheerful, constructive, useful, perhaps profitable to someone. But like if someone says, hey, I wrote a book on this, here's the book, do you want to read it? I mean, how many books can you read? Literally every book written in the history of the human race is available for free to you right now. Do you really want someone with a good idea to give you 250 pages and tell you to read it? Or do you just want them to boil it down to 1 sentence, 1 tagline, or 1 picture? Because I'm like, show me the picture. Okay, got it. Now I can move on with my life. Thank you.
You're making a lot of sense to me, Michael. Stay with us for a second. Let's bring in our social correspondent for the day, Yahoo Finance's Ali Canal, with some of what she's hearing from our online audience during this interview. Ali.
Yeah, well, Brian, Michael Saylor just talking about infinite content on social media, which is the perfect segue since we are talking and taking your questions on social media. Plenty of viewers chiming in and starting off with a strong one here, Michael. First question, do you see Bitcoin catching up to and surpassing gold's market cap by 2035? What say you?
I do. I think we're in a Bitcoin. We're in the digital gold rush, and 2035 is the 0.99 year. That means that 99% of all the Bitcoin will have been mined in the year 2035. If you want Bitcoin, you need to get it between now and then, because the last 1% of Bitcoin comes out over 100 years. Yeah, there's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
And another social viewer wants to know, why should an investor buy strategy stock instead of a Bitcoin or spot ETF?
Yeah, if you don't want to take any counterparty risk, and if you have a long time horizon, then you should probably buy the Bitcoin because you can take custody and take it anywhere in the world. If you simply want the asset, you want it in a brokerage account, you should buy the ETF like IBIT. It's going to take you 10 seconds to do that. It's easy to borrow against it. If you're a believer and you want amplified exposure to digital capital, and also if you believe in digital credit, like our mission at Strategy is we want to give 1 billion people a bank account that pays them 10% tax deferred. If you think that's a cool idea to give someone in Japan or Europe or Switzerland or New York City a bank account that pays them 10% with no volatility, and if you think that Bitcoin can power that, then you're buying our stock because we're a digital credit factory. And if you want to outperform Bitcoin and you're ready to get on the roller coaster, you should buy the equity. But if your time horizon is less than 4 years, if you need the money back in 4 weeks or 4 months, then you probably want something principal protected. You want low volatility. You should buy a credit instrument. Like STRC is literally designed to get the vol, down. Right now it's 7, whereas Bitcoin's vol is 45 and Strategy's vol is 65. And if you want something that's going to be extremely low vol, you should buy a credit instrument like a treasury credit product like STRC. You'll outperform your money market. You might very well do as good as the S&P index, but you'll be able to buy it and sell it and get your capital back, in a month, in a quarter, in a year, and you don't have to, worry about the roller coaster.
2025 is already almost in the tank here, and we got to think about December trading, which tends to be quiet towards the end of the year, just in time for the Santa Claus rally, with a few exceptions. And on today's Stocks in Translation, we break down how stocks tend to trade in the last month of the year to help get your portfolio ready for 2026. First, let's take a look at how the S&P 500 index tends to perform in each month of the year. So there you go, 12 months, 12 bars there. The only down month here, and this is going back to 1990, tends to be September. And I'm using the median, which is kind of like the average, going all the way back to 1990. Now here's December, and you can see it's a little bit less than November, which happens to be the best month of the year. That's what we're wrapping right now. And it's kind of in the middle of the pack, but nevertheless, it is positive, or it tends to be positive about 80% of the time. So those are pretty good odds that we have with us. Now I want to show you a couple different models that I've been updating this entire year. Now, what is in white here is what has actually happened. And the first thing you notice is there's that big post-Liberation Day dip and the blistering rally that we saw off of that. Now I have two different maps in here. The median since 1990, that's the green line. That's basically tracking what I just showed you in that other chart, except this is updated on a day-to-day basis. What you need to focus on here is the month of December. Here's where we are. As we enter December, this just gently drifts up into the end of the year. But I actually have a different model that I have found to be very accurate, not only this year, but the last one. And this is based on the median since 1928. So that's going back a really long time, but it actually doesn't include most years. It only includes the years where we match up perfectly with the day of the week. And so what this is saying is we tend to get a nice rally into the end of November, which is kind of what we're having right now. And then we take a little bit of a dip into the middle of the month, and then we re-accelerate into new highs into year end. I would separately add that by the work of Almanac Trader, that's Jeff Hirsch, he's a friend of Stocks in Translation. He has also said that when markets are up big, the way they are now, coming into December, we tend to see consolidation for the first half of the month. So we might expect a little bit of sideways, but again, anything can happen because what we call seasonality, those tendencies based on history, well, that only accounts for about 1/3 of price action. Reality, what the catalysts are and what we face on a day-to-day basis, that's at least 2/3. Now, I want to cover another market that's related to all this. This is the VIX Volatility Index. And a quick refresher here, the VIX goes up when stocks go down, for the most part. That's just kind of a loose interpretation there. But the green line is what has happened this year. And again, I'll point out this big post-Liberation Day spike. We haven't seen anything like that in quite some time. And then we had a couple of volatility spikes in October, and then I believe just a few weeks ago. And those were pretty muted. Nevertheless, the white line is the average from 1990, and you can see that after peaking in October, it just kind of gently stair steps down into the end of the year. And that's as traders go on holiday. We don't typically see a lot of volatility. So it would be really unusual, though not unprecedented, to do so. So having said all of that, well, let me go back to my chart here. Here are a few final thoughts on December trading. First of all, we have markets, well, they tend to go up or at least sideways as volatility drops. Stocks rarely crash, but 2018, that was a big exception. When we do see big sell-offs at the end of the year, they tend to come at market bottoms and also tops. So that observation actually comes courtesy of Almanac Trader, who also notes that when stocks are up big into the end of the year, as I just noted, we tend to see that consolidation for the first half of the month and then a rally into the second half into the end of the year. Also, although we didn't talk about it today, small caps, they tend to do better than large caps, the S&P 500. And finally, you've probably heard of the Santa Claus rally. It is actually the last 5 trading days of December plus the first 2 of the new year. So that's your start for 2026. And for more portfolio tuning tips and tricks, tune in to the Stocks in Translation podcast. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
As we gear up for the busiest travel week in the U.S., Deloitte's annual holiday travel survey shows over half of Americans are planning to take a trip. However, they're cutting back on overall vacation spending with an 18% decline in the average budget. To break down more from this report, Mike Daher, Deloitte Vice Chair and U.S. Consumer Industry Leader. Thanks for being here. So let's talk about holiday travel first and kind of what stands out to you from the survey in terms of what to expect from holiday travel, not just this weekend, of course, but throughout the holiday season.
Sure. Well, we started tracking holiday travel since the pandemic, so for about over the last 5 years. We're seeing this year, a record amount of people planning to travel at 54% of our respondents to our survey, which is up 5% from last year. So that's good news. Consumers are valuing time with loved ones over the holiday season. And that's any time between this Thanksgiving holiday break through about mid-January. But the way they're traveling is different this year. They're planning to spend less, as you mentioned earlier. It's 18% down on average with their budget. They're planning to spend more time, stay, for example, with family and friends at 22% of our respondents, and that is up from 19%. And good news for folks who are a little bit worried about congested, airports. 57% are planning to drive, and that's up from 10% last year.
So I was going to ask you how they're going to save that 18%, but I guess you just gave me a couple of ways. They're going to drive instead of flying. They're going to stay with friends instead of maybe getting a hotel or Airbnb. And obviously this reflects, we keep talking about affordability. And I guess this is a factor of that sentiment. Did you ask people also kind of how they're feeling, what's leading them to make these kinds of decisions?
Sure. Well, we've been tracking an overall consumer trend since last spring around value seeking. Consumers looking to get a bigger bang for their buck in all of their spending. And this holiday season is no different. In fact, 70% of consumers in our broad survey said they're looking to value seek both in what they're planning to buy in presents and goods, and then experiences that they plan to have. And that comes down to issues like the point you just made around affordability. 39% of our respondents said they can't afford it, and that's why they're planning to adjust their budget and travel plans. 31% or 32% said travel's too expensive right now. And 23% rather spend on other things. So the consumer is at various points throughout this holiday season looking to stretch their dollar, whether it's on gifts or experiences. And I think it really comes down to the fact that 31% said their personal financial situation has worsened since last year. And that is up from 26% in 2024.
What really, just if I can stop you right there, because what really struck me from those respondents is that it's about 1 in 5 high income travelers are in that cohort, that say that they're worse off financially, which I found a little bit surprising because we keep hearing this narrative about this sort of two-speed economy or K-shaped or whatever you want to call it. Were you surprised by that, and was that a big change?
Yeah, that was a bit of surprise. Households who make over 100,000, to your point, are planning to take less trips this holiday season. So it's on average 1.9, down from 2.5 last year. And they plan to decrease their budgets by 16%. So it sounds like both the lower income households, but also those households over 100,000 are looking to stretch their dollars even further.
Are there things that people are willing to spend on when it comes to their travel?
Yeah. So for those that are planning to spend more, they're willing to take longer trips. They're looking to spend a little bit more once they get to the destination, have a really good time. We're also seeing a little bit of an increase this year in international travel. Luxury lodging's up a bit. Flying over driving for those folks who are willing to spend a bit more, that's up only 2%. Better lodging locations is up 4%, and upgrading their fare class is up about 5%.
And then finally, Mike, generative AI. A lot of people are using that to help them make their travel plans. How many of them, and kind of what are they using it for?
Yeah, so it's around 25% are using generative AI to plan itineraries, research, travel options, whether it's airfares or hotel and lodging, but certainly finding activities, how to spend time with loved ones, really maximize that time. One thing I'm pretty heartened by in this data is we saw this trend happening prior to the pandemic, and it accelerated a bit after the pandemic, but people still value travel and experiences with loved ones, even when they're feeling financial pressure. We saw about folks spending 10% less on holiday this year, but the bulk of that's about 16% is in buying goods, where the decline is less in experiences. So for me, that's heartening. Consumers are value seeking, like we said, and there's a lot that travel companies can do to provide a higher ROI on consumers' travel spend. Things like reliability, making sure their bags show up on time, seamless check-in, things like that consumers still value, that we're seeing in our data.
Yeah, having a good experience is definitely a premium these days because it's not a given, unfortunately. Mike, thank you so much for your perspective, for Deloitte's perspective. Appreciate it.
Thank you, and happy Thanksgiving.
Thanks, you too. That's it for Market Catalysts. I'm Julie Hyman. Thanks for watching. We have more Yahoo Finance coming up.